Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Earnings season is in full swing, and we're getting a little bit of a picture of what's going on in the housing industry. D R Horton is the company that reported earnings recently, and I wanted to get a little bit of a feel for what was going on with that company. To do that, I asked Jason Hall to join me. Jason, how are you doing today?
I'm good. We get to have a little bit of a debate here because you and I have a slightly different view of the housing market and home builders.
That's right. I mean, we're probably not too different, but I think there's a lot more questions. But give us a little bit on what their earnings looked like and what that tells us about the state of the housing market right now.
Yeah. So first, housing is 20% of the economy. It's a massive portion of the economy. As we all know, anybody that's written a rent check or made a mortgage payment lately, you know it's a big part of the economy. D R Horton has been the largest home builder in the U.S. for about 20 years. So it's definitely a bellwether, an important company in the industry to follow. And essentially things came in about where we expected. So its first quarter for its fiscal 2023 is the fourth quarter of 2022, like the calendar quarter. So ended December 31st. And revenue was up about 1%, so $6.7 billion. Now that's home sales revenue, right? So it has other businesses tied to like financing and that kind of stuff. But like if you just distill it down to just home sales revenue, it was up just a little bit. Gross margin was about 27%. This is an important number to follow for home builders because they have the cost pressures, the 3 L's, land, labor, and lumber, right? So thinking about how those things are affecting its margins, 27% is pretty good, but it started to come down compared to a lot of the industry over the past couple of years. Earnings per share, it's a very profitable business, $2.76, down by 13%. If you look at it compared to net income was down about 16%. Big share repurchases that have happened last quarter. The timing was pretty good if you look at where the stock price was with those repurchases. And here's what's happening. The number of homes closed in the quarter, over 17,000, was down about 6%. Again, home sales revenue was up 1%, 6% fewer homes. Pricing, right? We know about the story with housing prices over the past 3 years. Over the past 5 years, I think the average median home price is up like 50%. So we see that pressure. Now, here's where things start to, I don't want to say come unraveled, but like this is where we're seeing the real pressure of this housing cycle turn. Interest rates having rise so sharply over the past 6 months. Home orders, so again, homes closed, that's maybe it was ordered in the quarter, maybe it was before then, but this is customer bought the house and it was delivered to the new owner, right? Is closed. And then home orders, somebody signed on the bottom line to commit to buy the house, 1,382. That was down 38%. Again, 6% decline in closed homes, 38% decline in home orders. Massive decline there. And then moving over to cancellation rate. A year ago, the cancellation rate in the same quarter was between 12 and 15% is usually where it is. It was 15% a year ago. Skyrocketed, Travis, to 27% cancellation rate. You know what that was? That was people that signed up to buy a house in October, and by the time the house was ready to build, they didn't have a rate lock on their mortgage, and they were priced out of the house on the mortgage, right? So that's a real pressure that they're feeling.
So this is a company, you look at it on the surface, I'm looking at Google Finance right now, trading for 6 times earnings. But what you're telling me is that this new home orders dropping 38%, maybe even gross margins are going to come down a little bit. You still have operating costs. So this is potentially a company that goes from being a price earnings multiple of 6 to not being profitable, potentially, depending on how bad things get. But that bears no bearing on what the future of the company looks like. I wanted to ask about a few of these pressures because I think we are exiting a very strange time in the housing market.
Yep.
Interest rates seem like they're going to stay somewhere around where they are today. They're not going to go back to 2% for the foreseeable future anyways. Is there just going to be a reset in the amount of demand there is for housing? Is it going to take 5 to 10 years, kind of like it did? Remember the housing bubble in 2008, 2009, I lived in downtown Minneapolis at the time. I was looking at condos. It took 10 years for that market to go anywhere.
Yeah.
And I think you could say that across the country. Are we going to kind of go through a similar dynamic in the residential housing market where, hey, I am anchoring on the fact that in 2021, my house was worth $500,000 And unless I really have to move, I'm not going to take less than that to sell the house. I guess it just seems like a very sticky and difficult market to figure out exactly where there's going to be these major tailwinds. But what are your thoughts there?
So I'm glad you brought up the global financial crisis, right? The true, real housing crisis. We're in a different situation with housing now than we were back then. The prior decade, coming into 2007, 2008, and then when the bottom really fell out over the next 2 or 3 years, was a product of massive overbuilding. It became just the popular consciousness in the US was wealth isn't owning homes. Home values only go up. Anybody that's invested in stocks since early 2020, stocks only go up until they don't. Essentially the same thing happened with the housing market. The difference is it's such a massive part of the economy, and you saw this massive washout. You had this enormous amount of excess housing inventory that had to be sold through. As a result of that, a lot of home builders went out of business. A lot of people, skilled labor, they had to find other jobs because builders were not building homes. And it took multiple years to get through that, Travis. And honestly, it's kind of fed into where we are now, where we have a dislocation. So again, that 20% of GDP, the U.S. economy is tied to housing. A lot of it is tied to existing homes, right? And the reality today is we simply don't have the existing homes inventory for sale to meet the demand. And there has been a massive underbuild of new homes over the past 6 or 7 years. So that's where we have this massive dislocation. So that should be good news for anybody that's bought a house relatively recently that has no intention or need to sell, is that it's not going to be like we saw homes that were sold in 2006 that didn't return to the same price until 2015, and like markets like Southern California, right? So where we're talking most of a decade to recoup the value. I don't think we're going to see the same thing, but I do think we have a situation where we have a lot of people that are trapped into their home today because of their mortgage, right? They can't go buy a bigger house. And this is a bearish concern that you brought up before. They can't go buy a bigger house because they've got a 3% 30-year mortgage today. And even though they have equity, moving to a 6% mortgage, even if it's the same price they pay after down payment, Travis, they can't afford it, right? They can't afford to do it.
Yeah, you can't afford to double your house payment. You know, might be the example if you're getting 20% more house.
And I think that's one of the things that we're not considering that's probably affecting that existing inventory, right? Particularly, there's a lot of older Americans that refinanced and took cash out at some point that maybe they have a mortgage now and they'd like to downsize. But maybe it's just not something they can really consider doing now because, again, they have a 3% mortgage and they can't downsize and end up with the same payment just to get a smaller house with no financial benefit. So that's what brings me back to the companies like Horton and some of the smaller home builders that I'm really interested in is they're in a good position to fill that dislocation, particularly when we look at where the demographic trends are showing that people are relocating to because of things like being able to do more remote work. Maybe you can live in a lower cost of living area if there's housing and have a job that typically you would have had to move to a high cost of living area.
Yeah, and maybe this is just a low point. I don't know. We'll see. The stock has actually
That's the other challenge, Travis, is that
the stock has come up
The
here
low point
recently.
for these stocks was 3 months ago. They've largely recovered. So the way I think about it, as bullish as I am on the market, I'll be blunt with you. I think there's still a lot of risk for home builders, and it's going to be a weak year, and I'm not sure that's fully priced in.
Yeah, that's probably a good way to look at it. Long-term optimistic, short-term cautious.
There you go.
Well, what do you think about the home building stocks, home building market right now? I'd love to hear your comments in the comments section below. Follow Jason at The Smattering and follow Riiv Investing here, of course. Thanks for watching, and we'll see you here next time.